Greetings, everyone. Welcome back to our Finspire Focus on the Market series. I'm Chris Karam, Chief Investment Officer with Finspire. What's a quantum? I know this year flew by, and the last couple of years have been dominated in the equity markets by artificial intelligence. We're going to shift to give you a little preview of what we think is you're going to hear a lot more about in terms of quantum computing, and have a little fun with it along the way when we do our quarterly update for the last quarter of 2025, and give you a look ahead at what to expect into 2026. So let's get right to it. As always, we share facts and also our opinions about not just what occurred in the third quarter, but also looking forward to the end of the year and going into next year. So first, we start with the basics of quantum. And if you're reading the definition, I'll give you a moment here to read it. It's complicated. We're going to break it down into some simpler concepts and terms, but it is a very much an emerging innovation and technology in the affecting not only the equity markets, but has investment implications across the board. So we'll get to it. Let's see what happened in the third quarter on our capital market strategy board and how to prepare your investment portfolio for this environment. First, let's look at the economy. Strong second quarter growth at 3.8% after revisions. Third quarter is also expected to be pretty good, around the same number, about 3.8%, according to the Atlanta Federal Reserve. We'll see. That's supposed to be released at the end of October, but we are also seeing weakening labor demand, or labor supply and demand. So the labor market in general seems to be softening, which should give the Federal Reserve at least, two opportunities, I should say, for the rest of this year, both later this month in October, but also in December, to cut short-term interest rates, which could really be really assist the borrowing costs, of course, for both companies and for individuals. Let's look at the markets. Third quarter was an everything rally in the equity markets. Domestic equities, U.S. large caps, U.S. small caps, which did very poorly, which had been doing very poorly in the first half of the year, really rallied as soon as there was a signal that the Federal Reserve were going to start cutting short-term rates. Small caps really rallied, actually outperformed large in the third quarter. And then we've seen continued gains in overseas equities, both developed and emerging markets. And then diversifiers like gold, Bitcoin, others, all doing very well in the third quarter. So it was an everything rally. Fixed income even performed really well and was additive to the portfolio, additive to a diversified portfolio. So we're going to get into that more about what that looks like. Politics. Okay, it's been a busy, obviously, first year of a new term is always a busy political year. The headlines, the legislative actions have been voluminous this year. We had the one big beautiful bill that was signed in July. Tax rates were the primary feature of that, but also some other things like border security and others, and defense spending. But all of that, despite all of that, we're left with a fiscal year end the government fiscal year end in September 30th, 2025, somewhere around a $1.7 to $1.8 trillion deficit. So massive deficits again, and that has significant investment implications because now the actual budget itself is carrying about 1.2 trillion of just interest on the debt. And that is up almost three to fourfold from where it was just 5 years ago in 2020. So because of higher interest rates, we're paying more on debt, we're paying that interest on that debt, and we're still adding large deficits along the way. So something's got to change here, and hopefully the next fiscal year, beginning October 1st of this year, hasn't really kicked in yet because the government has been shut down. All right, so that's been leading to some angst and anxiety, perhaps a contributor to gold prices rising the way they have over the last couple of years. But historically, more global peace has led to lower gold prices. More global unrest has led to higher gold prices. Perhaps that relationship is starting to break down a bit, with central banks around the world continuing to buy and demand that they have gold just to hedge against currency debasement around the globe. So the markets don't seem to be impacted yet by a government shutdown, but I say yet because if this goes another 30 days, say to Thanksgiving, we could have some significant market and investment implications on our hands. Okay, quantum computing versus artificial intelligence. This here is a picture of an element of just one component part of the IBM quantum computer. They're massive. They actually have to sit in very, very cold places as well in order for them to run properly. Look, at the bottom line, as I mentioned, we've seen artificial intelligence not just ripple through the equity markets, but then it's starting to impact us in our daily work lives, right? Whether it's daily workflows, assessing PDFs, or creating emails for us, or helping us do all those things from a communicative and analytics perspective. Whereas artificial intelligence is that ability for machines to really help us expedite things that we need to do as humans. Quantum computing is there to actually to pump up the speed at which complex calculations are made. So you put those two technologies together, and it really creates a powerful force of productivity potential in our economy. So we're just scratching the surface on quantum computing, and it just seems like we're just getting a handle on artificial intelligence. But quantum computing is very quickly coming to form and going to start impacting the economy and the markets. So I told you we're going to have a little bit of fun with this, and so our good friend Doc Brown from Back to the Future gave us a little foresight, a little window of what to expect 40 years ago.
But I need a nuclear reaction to generate the 1.21 gigawatts of electricity. 1.21 gigawatts! 1.21 gigawatts! Great Scott!
What the hell is a gigawatt?
What the hell is a gigawatt? Well, actually, a gigawatt is really important. So we need gigawatts of power to power these AI, artificial intelligence data centers, and to actually make AI a permanent and investable concept for years to come. As a matter of fact, today we need about 10 gigawatts of power today to power AI, everything AI related. But by 2027, it's estimated that AI data centers in particular, the estimate is that we're going to need 68 gigawatts of power to power AI data centers. So we've got a long way to go. We have to dramatically increase capacity, and that's what creates such an interesting investment opportunity, not just for artificial intelligence company stocks, but also for the power and the energy sources needed to fuel those AI data centers, and also those quantum computers, which are running all the time to make these complex calculations. All right, let's get back to the markets. The third quarter, we mentioned, was an everything positive rally. It's interesting that we had an 8% return quarter on the S&P 500 in the third quarter, but that was on the heels here of a 2025 second quarter rate of return of 10.9. So we have back-to-back quarters of really significant growth, and that was after equity price increases and growth. That was after a 19% drawdown between February and April in the equity markets due to the new tariffs that were proposed by President Trump and his administration. So we have rebounded dramatically, and all these orange lines represent is that since 1988, these are some of the strongest quarters that we've had since 1980, which are mostly on the right side of this page, just in the last two quarters alone. So really nice rebound from the 19% drawdown earlier this year. But that being said, that's just on the S&P. If you still look at where international equities are performing, they're performing above the S&P. So here we have 15 years of history. We've looked at this chart before. Emerging markets and developed non-U.S. markets are leading the way in 2025. That hasn't been the case for years, where the S&P was outperformed by overseas equities. It's been a long time, and so a lot of this has been overdue. But it's not just overseas equities. We're seeing strength in other areas. I mentioned small caps, which now are up over 10% year to date. As of September 30th, they were hanging around zero after the second quarter. So really strong quarter for small caps. But then if you look at commodities and bonds, also additive to a diversified portfolio. So a diversified portfolio, if you're looking at all these different asset classes, I know we've talked about this the last quarter or two, but this has been the year to be diversified. Whereas in the last couple of years, it's just been U.S. equities, large caps, and forget it. Not only that, it's been U.S. equities, large cap growth areas like technology, communications, consumer discretionary stocks. This year, value equities or value sectors, maybe it's energy, materials, utilities, are really starting to, financials are really starting to perform well and perform better than they have in the last couple of years. So it's a good sign to see the broadening of the returns coming from various sources, even within the U.S. equity market itself, and even within that U.S. equity large cap space, and not just relying on growth equities along the way. So All right, let's take a look at just economic growth. It's been a really interesting ride because we had this big front running of imports in the second quarter to front run before the tariffs came into place, which would theoretically make those goods that companies were buying and individuals were buying more expensive. So you see that in both in the business spending here in the second quarter, and I should say in the first quarter of the year in this orange line here, only for that to fall off in the second quarter GDP report naturally, right? This doesn't usually exceed consumer personal consumption expenditures, which are over here, and that sort of reversed course in the second quarter. Likewise, we saw a big rush of imports in the first quarter, which is down here, which caused a negative component to the GDP because there were more imports than exports. Only that to be reversed in the second quarter, where we had greater exports than imports. So what does this mean? When we take a look at this lens of economic growth through the lens of artificial intelligence and quantum computing, look, according to McKinsey and Company, by 2030, $5.2 trillion globally is going to be spent on AI workloads and data centers. It's a massive investment opportunity. And the business expenditures, the capital expenditures from business have been, even the ones that have been announced from them publicly, are really in those trillions, hundreds of billions and trillions of dollars. S&P 500 firms alone, just to give you a sense, account for 250 to 300 billion dollars in near-term capital expenditures in artificial intelligence. So the train is running down the tracks on the artificial intelligence spend, capital expenditures. But as I described a moment ago, it's not just about those semiconductor chips and say hardware like the computers themselves that are running these machines and the data centers. It's all of the related trades. It's the financials, the banks that need to finance these the AI data center projects. It's the energy suppliers that need to supply a diversified source of energies because our grid can't handle all of the power needed to power all these AI data centers. And then you start looking at quantum computing right on the heels of artificial intelligence. Look, the economic influence could approach 1 to 2 trillion by 2035. That's not that far away. That's just 10 years from now. And so we are looking at iterations of multiple evolution and innovations in technology that are going to have not only significant investment opportunities, but they may really change the way we just operate at the workforce. All right, jobless claims. Let's look at the labor market. The labor market I mentioned has been soft, but it hasn't been a situation where we've seen mass layoffs. We've seen very muted month to month labor statistics. We don't have September's yet because of the government shutdown. So we're looking at instead jobless claims. And I know there's been some controversy around the quality of the data that the Bureau of Labor Statistics have collected in order to calculate our unemployment rate, the month that is released every month. But what we do know is we feel pretty good about if someone's claiming jobless or filing for unemployment claims, then we pretty much have a good idea that those people have been laid off or they're in transition. And we haven't seen a lot of movement in the initial claims. Those initial jobless claims, you can see right here, have been just remarkably steady. And over the last 4 weeks, they've been remarkably steady. So we're looking at different forms of data that we know we can maybe have a higher degree of confidence in today to really get a good understanding of what's happening in the labor market. Yes, it's soft. We're not creating a ton of new jobs. At the same time, there haven't been mass layoffs. So something has to give here. And that's kind of why the Fed is thinking about, hey, we know one of our requirements is to review the labor market. You may hear the Fed say we're cutting short-term rates because of the labor market softness and weakness that we've seen the last few months. All right, let's go to earnings. Now, I mentioned the third quarter was an everything positive quarter. Asset prices, market prices went through the roof with those big back-to-back quarterly gains. And that's left us a little bit ahead of where the earnings of the S&P 500 are right now. So what does that mean? That means valuations are really high. And this is where we got to be careful because sometimes when you get in these higher valuation phases of the market, similar to, say, the year 2000 or late 1999, we got into some technology companies that had really high valuations but didn't really have earnings. And that was kind of a sign of an early stage of a bubble, as it turned out, looking in hindsight. Going forward here, these quantum computing stocks, they don't really have positive profitability and earnings quite yet. So You can see one company in particular I just highlighted, Quantum Computing Inc., actually has ongoing losses. They don't have profits yet they had a total return over the 12-month period ending October 23rd, 2025 of 1,215%. So you can see where there's a lot of excitement, enthusiasm built into some of these stock prices, to say the least. And we don't want that to permeate throughout the rest of the markets, because that means we might get really, really overbought and get really way too expensive for where earnings reside today. That being said, second quarter and so far earnings in the third quarter have been really strong, so kind of holding those valuations high. And it doesn't matter how you measure valuations, whether it's price to earnings ratios, which is a really common way to look at things, but you can look at a number of different ways. They're even higher, those valuations, with really across the board, depending on how you value it, they're all higher than they were 12 months ago. Okay. So it was an expensive market then. It's an expensive market today. It doesn't mean that the bubble's going to burst. It doesn't mean that right away. It doesn't mean any of that. It just means that these elevated valuations can last for an extended period of time until something changes. Now, in this case, we have two things that are really favorable for the equity markets. One, we have positive economic growth, and if it does clock in the way the Atlanta Fed estimates at 3.8% again for the third quarter, that's a really strong sign. And we have falling short-term rates, which means the value of those earnings it expands as short-term rates fall. So that's the relationship. So we have two things going for us, which would really allow for us to maintain elevated valuations. So it's important to know that. So we're not just stuck. We're not stuck here, but
How could I have been so careless? 1.21 gigawatts? Tom, how am I going to generate that kind of power? It can't be done, can it?
Doc, look, all we need is a little plutonium.
Oh, I'm sure that in 1985, plutonium is available in every corner drugstore, but in 1955, it's a little hard to come by. Marty, I'm sorry, but I'm afraid you're stuck here.
doesn't necessarily mean we're stuck here. Now, we do need some plutonium, and we do need other sources of energy that may be non-traditional sources to fuel all this growth in this area of artificial intelligence and quantum. Maybe it's natural gas that we need to really unleash. Maybe it's uranium. We're seeing a lot of interest in building solo nuclear reactor sites so that that nuclear energy can power energy reactors and so on. But this is why it's such an interesting investment case, is that you do have this multitude of opportunities, not just in chips, but also in all these other areas that we've been addressing. All right, let's get back to the markets and in the earnings situation. And here's where, when we say something has to change in the market, right now, if you take the price to earnings ratio, I'm going to get a little technical here, but if you take the price to earnings ratio, which is the price of the S&P 500 stocks divided by the earnings generated by the S&P 500, and you flip the numerator and denominator over, you come up with something called an earnings yield. That earnings yield today is really close to the value to the yield on the 10-year Treasury. Well, when that happens, they're both about 4.2. Well, I think the bond yield, 10-year bond yield today is 4%. Earnings yield's about 4.2% or 4.4% at the end of September. When those two things get really close to each other, that means stocks and bonds are nearing a point of equilibrium, valuation equilibrium. Doesn't mean it has to stay that way. It just means that the competition for stocks and bonds at today's equity market valuations are a little high. Bond yields are around 4%. So when you put those in competition for where the next dollars are going to go, it appears equally interesting to invest in bonds and stocks. Now, like I said, something should change. We could end up with lower interest rates, which changes these calculations. But for the time being, we're in this state of equilibrium. Now, let's talk a little bit more about interest rates and the pressure on rates, which has come largely over the last few years, come from excess government spending. Now, a lot of this comes back to the COVID years, 2020, 2021, where we ran up significant deficits. It led to massive inflation and led to higher interest rates. We're still going to run a deficit this year of, like I mentioned earlier, about $1.8 trillion. However, which is just ever so slightly less than fiscal year 2020, about 2%. More importantly, the deficit as a percentage of the GDP is down from 6.4 to 5.8%. But because we have higher rates from the from the big run up in deficit spending in 2020 and 2021, the interest on the debt now is eclipsing 1.2 trillion just in our federal budget. So, it is, and that's up from 378 billion in fiscal year end 2020. So you can see the trajectory we're on. We need to cut deficits. Washington D.C. and Congress needs to cut the deficit in order for us to really prosper in today's economy, and to have the markets continue with this trend that they've been on. Okay, so when that happens, where do investors go? They say, look, you are running, and I'm saying you, whether it could be the U.S. or it could be any other country in the world, you're running big deficits. I'm going to put my money, I'm not going to invest in your currency as a result. I'm going to hedge my bets a little bit, take a little off the table, in our case, say the U.S. dollar, and I'm going to buy Bitcoin, or I'm going to buy a cryptocurrency. And what's really interesting about that is, I mentioned the legislative session has been very busy this year in Washington, D.C. One of the things that was passed was called the Genius Act. Well, the Genius Act was signed into law after the One Big Beautiful Bill, July 18 of this year. And it paved the road for a regulatory framework to allow for stable coins. And stable coins can be offered by, say, an e-commerce retailer. And those stable coins can be backed by the U.S. Will be backed by the U.S. dollar, so that you can exchange as a form of currency these stable coins for goods and services from a sponsoring organization. So this is going to be really interesting how this takes off, and it really could be a huge boon for the cryptocurrency industry, not just Bitcoin per se, but for the cryptocurrency industry as a whole. And again, it could be changing the way soon, maybe not right away, but soon, on how we are purchasing things, whether it's from an e-commerce retailer or somewhere else. Look for a stable coin near you in the near future. The other alternative has been gold, right? So gold's been one of those things that's been around for millennia. It is a currency alternative for sure, and what we've seen is from the data is a lot of interest from central banks around the world in purchasing gold to manage the risk of currencies being debased based on deficits, continued government deficits country to country. So it's almost like central banks are hedging against themselves, their own countries, and the global situation. And you can see the strength in gold here relative to the S&P 500. There was this big gap here, and then after 2020, when there was a lot of government spending, people started looking at different alternatives, and central banks started looking for ways to hedge. And you can see the demand for gold has been significant over the last several years, and it's run up the gold price dramatically, especially when and look how well the S&P 500 has done over this period of time. We're talking about over the last 20 years, and gold now is doing almost as well during that period of time, amplified specifically over the last several years with a big run up and big demand for gold. So what can we expect going into 2026? We mentioned it, lower short-term interest rates. Look, lower short-term interest rates allows businesses and individuals to expand borrowing capacity. It may even be a good sign for the housing market. The housing market's really been at a standstill with high rates, lack of supply. Lower short-term interest rates may rattle that cage a little bit to get more supply on the real estate market, which in turn should allow for lower mortgage rates in the future. That would be huge. That would be really important for the economy. And we think that's to be determined in 2026, but look for that to be a positive signal to help our economy in 2026. All right. Opportunities remain in diversifying asset classes. We don't believe you've missed the boat if you've been in these if you haven't yet diversified into these other asset classes, whether it's U.S. small companies, whether it's overseas equities. Look, the U.S. dollar has been in decline over the last year or so. Those don't tend to be short-term trends, changes in currencies. Those tend to be longer-term trends in nature. So there are also a lot of attractive valuations. And even though over the last 15 years it's been a growth-led rally, value sectors see a lot of it. There's a lot of potential still remaining. So you haven't missed out on anything in these diversifying asset classes. Don't forget, from a political perspective, 2026 is an election year. It's a midterm election year. Markets behave a little bit strangely in midterm election years traditionally. They're kind of weak in the first, call it 8 months of the year, on the weaker side. post midterm election, they finished really strongly. So we'll see if that comes to fruition yet again in 2026. But that's something you can expect to see. Maybe a bit of a sluggish market to start the year, in the first half of next year, fueled by a post midterm election rally, which historically has been pretty significant. So, like I said, it's kind of hard to believe that it's the last Focus on the Markets quarterly edition for 2025. Can't thank you enough for tuning in, and so does Marty McFly.
I'm sorry, but the only power source capable of generating 1.21 gigawatts of electricity is a bolt of lightning.
So, no bolt of lightning required, but rest assured, Marty McFly took us back to the future in 1985, almost 40 years ago today, and it was a great movie then. It was a great movie today, and interestingly, our search for gigawatts was very prophetic 40 years ago, and we will search for more in 2026. Thank you for listening and catching us on the Focus on the Market series. We'll catch you again in January in the new year.